What's up, everybody? It's Greg. So we're going to talk today about what we've seen a lot in the news, and that is stock market crashes. Stock market crashes have been a huge part of our history in the United States of America. So today I'm going to talk about some of our past stock market crashes and the lessons that we should have learned, and also the lessons that we should learn in our current stock market crash. So like I've said, we've seen stock market crashes throughout history. So in October of 1987, there was a thing called Black Monday, where we saw one of the biggest daily drops in the stock market ever. The stock market crashed by over 20% in a day, which resulted in them implementing some rules called the circuit breaker rule. So the circuit breaker rule is similar to just how you think of it with electricity, where you can flip a switch and it turns off the electricity and the lights go out, and then you can flip it back on and obviously the lights come back on and you're able to see again. Similarly, they did the same thing with the stock market. They said if we see a 7% drop in a single day, we are going to flip the circuit breaker, take a 15-minute break from trading, and then turn it back on and see if we can help the market stabilize. They do that as well with a tier 2 circuit breaker, where after you see the 7% drop, if you see 13% drop in a single day, they will also flip the circuit breaker and wait 15 minutes to see if the market stabilizes. And then finally, they have a tier 3, where if you see a 20% drop in a single day, they will flip the circuit breaker and shut down trading for the day. In 1987, you saw the Dow Jones drop from 2,700 down to 1,800. Fast forward a little bit and you see the .com bubble of the early 2000s. You saw a huge drop in the NASDAQ, a drop of over 70% due to the bubble. The bubble was a result of overpriced internet-based companies. You ended up seeing PE ratios of over 200. The PE ratio is the price to earnings ratio. So that means if you spend $200, that means you're only getting $1 of earnings. So obviously that is a huge PE ratio. To pay $200 to make $1 is just absurd. Fast forward from there and you get the 2008 housing market crash. In 2008, we saw the S&P 500, the Dow Jones, and the NASDAQ all drop by over 50%. This was largely driven by the decline in the housing market, which resulted from the defaults on consolidated mortgage-backed securities. That's right, I'm smart. I can say big words like consolidated mortgage-backed securities. Because of the drop in the housing market, there was a loss in confidence in the stock market as well, and that ended up crashing the market. Because of that huge drop, that 50% drop in those stock markets, it ended up ushering in what's called the Great Recession. Fast forward to today, and we have the 2020 crash, which obviously is due in some part to the fear over an illness that has been spreading. On February 12th of 2020, the Dow Jones hit a record of over 29,000. Now the Dow Jones is sitting more around 19,000, so we saw over a 30% drop in just 5 weeks. That's 4 years worth of stock increases that have disappeared in about a month's time. So obviously I bring this up to show you that there are many crashes that happen in the stock market, and they happen for a myriad of reasons. They can be because of a housing market crash, or because of a bubble, or because of an illness. They can even happen because of tulips. That's right, tulips. They can happen because of a flower. One of the first known market crashes happened in the 17th century in the Netherlands. Tulips ended up being a means of trade, and they ended up appreciating in value to an astronomical amount. There was even a point in time where a single tulip bulb could buy you an entire house. Obviously, flowers aren't worth that much intrinsically, so eventually the bubble popped and tulip bulbs decreased in price, resulting in a huge economic downturn. So obviously, there's a lot of doom and gloom. Stock markets can crash, fear can come in, everybody can lose a lot of money, no fun. Alright, enough with the doom and gloom, let's get to the happy part. Also, I'm just kind of sick of saying the word crash 1,000 times. So let's talk about rebounds. The stock market crashes, but then it rebounds. You could even say the stock market has more rebounds than Wilt Chamberlain. If you don't know who Wilt Chamberlain is, Google him, all-time leading rebounder in the NBA. Anyways, historically the stock market has always gone up. It always rebounds. So let's talk about the 5 lessons we should learn during a recession. The first lesson we should learn is something that I learned when I was in Scouts. Be prepared. Which leads me to think, remember that old saying, do as I say, not as I do? That might apply here. Be prepared. Sadly, the Boy Scouts of America as an organization didn't really follow that, and they're going bankrupt. But if we take it into our own lives, we will be prepared for recessions because they do come. Rebounds also come up, but recessions hit and we need to be prepared for that. So I am going to channel my inner Dave Ramsey and tell you need to have 3 to 6 months worth of expenses in an emergency savings account. Obviously, that's a huge way to be prepared. I just clapped. I don't know why I clapped, but obviously that is a huge way that you can be prepared, is to have 3 to 6 months worth of savings just in case you lose your job or things get tight. You obviously have that money there to help you in times of need. Another way to be prepared is to ensure that you have a good job and to be indispensable. So to have job security, make it so that your boss would never want to get rid of you because you are so indispensable that his company would fall apart if you didn't have you. The next thing we can do to be prepared is to not have excessive debt. So that means to cut out credit card debt, and also, in my opinion, to not have car payments. So I don't drive an expensive car. I drive a wonderful 2008 Honda Civic. Yes, it is paid off and it is glorious because I do not have any car payments, and that is bliss. Really, the only thing that I would say to go into debt for is a reasonable house, and at a last resort for college is student loan debt. I say student loan debt as a last resort because I think there is ways to pay for college without going into debt, primarily through scholarships, grants, or, here's a novel idea, work. Yes, I worked through college. I worked at a call center and it was amazingly boring, but I did get through college debt-free. Another way we can be prepared for recessions is by cultivating a life of frugality during good times. If we learn to be frugal while the market's going good, whenever we hit these tough times and money gets tight, then we are already living that way, and so it's not going to be that big of a sacrifice to just live by a budget and make it through. Some big ways that we can be frugal is by avoiding the overpriced coffee that you're buying in the morning, or soda runs, or even making your own food, because eating out adds up so fast. Another way we should be prepared is to have enough money saved up that we can go and invest. So that brings us to lesson number 2 that we should do during a recession, and that is to smash the like button. No, I'm kidding. Lesson number 2 is invest. Dips in the stock market are really opportunities to invest. They're opportunities to buy stocks at a discount. There are many people who will be like, oh, but I want to time the market perfectly. I want to wait for it to hit rock bottom. Yes, that is a rock that looks like a bottom. They want to wait until it hits rock bottom so that they can buy and get the most out of their investment. And in theory, I completely agree. It would be awesome if we could time the market perfectly and always buy at the lowest point and always sell at the highest point. But I'm not a fortune teller, and I would guess that most of you aren't either. So what you need to do is to buy during the dip. And even if it goes down a little bit, it's still going to rebound and you're still going to end up making money over time. So for example, in 2008, the Dow got up to 14,000, and because of the housing market crash that I explained earlier, it dipped clear down to 6,600. So if somebody was investing in 2008 and it dropped from 14,000 down to 10,000, I would be thinking, man, this is pretty low, I should buy, even though it's going to continue to drop to 6,600. But say I bought at that 10,000 mark, even now, at 2020, even after the stock market crash, the Dow Jones is at 19,000. So it is still way up from that 10,000 that I bought at in 2008. So maybe you should be a little bit less worried about when it's going to hit rock bottom and more worried about just keeping money going into it and taking advantage of those down markets. You know, if you're consistently investing, even when it's going down, yeah, in the short term, it may look like you're losing money, but in the long term, the market will rebound and it always goes higher than it was before, at least historically, so you're still going to end up making money. That being said, we're going to see ups and downs in the market, and right now I do think the market will continue to go down for a little bit, but me personally, I am putting money in now, and I will continue to put money in even if it continues to go down, and I'll just hold it because I know the market's going to come back up, and I know I will be making money. All right, lesson number 3, don't get emotional. Do not let fear drive your decision making. I've said this in prior videos, but if you let fear drive your decision making, then you're going to end up making bad choices. For example, if I put money in now and the stock market drops 10% tomorrow and I let fear drive my emotion, I'll sell and I'll end up selling at a loss. Where if I just held it and didn't let fear drive my decision making, then obviously the market's going to come up eventually and I will be selling it at a gain. Which ends up leading me to lesson number 4, and that is to think long term. If you're always worried about the short term, especially when investing in the market, you're going to have some really frustrating times. Because really short term, the market's pretty volatile. It'll go up and down, up and down, up and down, but over the long term, you'll see this general trend upward. Even with all of the downtimes in the market that I've explained earlier, the 1987 drop, the early 2000s, 2008, 2020 now, we've still seen general trend upwards. So you've seen that those moments where it goes up, then it'll tank, but then it goes up higher than it was before. So you do see this long-term trend being upward. So think long-term when you're investing in the stock market. Yes, you can play the dips and the peaks. I do. I love it. I think it's really fun. I try and buy low and sell high, and I actually do that on a daily basis, but I don't do it with a large percent of my investment because I want that investment to be secure. And the best way to do that is to buy and hold and wait for that general trend to go upward. But it is fun to short-term play. I just wouldn't do it with all of your investment. Okay, so this leads me to my 5th lesson that I think we should learn during a recession, and that is to use good investment techniques. One of the greatest things that we can do in the stock market to reduce our risk is to diversify. You can do this on your own if you are buying individual stocks and companies, and that would just be by buying across a myriad of industries and by buying multiple companies. Or you can buy index funds, which will diversify for you and spread out your risk. This really reduces your risk just in case one company fails, you're invested in another company that's going to go up. Another good technique when investing in the stock market is to use numbers and logic. Each company that you're investing in is a publicly traded company. That also means that their finances are public, so you can go and look at their finances and determine which company is really implementing sound business practices and is going to grow in the future. So now that I've talked about the 5 lessons that we should learn during a recession, let's talk about some of the stocks that I'm actually investing in right now. Alright, so now I'm going to talk about companies that I'm actually investing in, and I'm going to put their tickers and their 3-month trend right up here. You'll see that these stocks are in industries that have taken a real dive with this illness, and that's why I think they have the most potential upswing. Alright, so first, Carnival Cruises, and it has dropped by crazy amounts, 80% in the last 3 months. And then you have 2 car rental companies, Hertz and Avis, and they have dropped by over 50%. And then I have 2 airlines, Delta Airlines and Spirit. Delta has dropped by over 50% and Spirit has dropped by over 70%. Finally, I have Cisco, and not the CISCO, but SYSCO. Cisco is a food distribution company, and they have dropped by over 60% in the last 3 months. The market as a whole has dropped by more than 30%, so when I see companies that far exceed that drop, then I see opportunity. And these companies, they're big companies, and they have dropped by more than 50%, and some of them by more than 70%. So that's a huge opportunity to see big gains. That's right, big gains. So once eating out, once travel comes back, obviously car rentals go up, cruises go up, airlines go up. All of those stocks will see a huge jump. Also, the government is thinking about a stimulus package that will bail out airline companies. So I think those airline companies are really a safe bet because they're not going to fail. They're going to get money from the government potentially, and once travel comes back and business goes as normal, then you're going to see a big jump in them. Obviously, there are a lot of companies that are going to have some big upswings. These are just a few of the ones that I'm currently investing in. So remember the 5 lessons that we've learned. Be prepared, invest, don't get emotional, think long term, and use good stock market techniques. Hopefully you found this video useful. If you have, please subscribe and the content will just keep flowing.